I'm in the studio. I'm now joined by Anthony Clark. He is an independent analyst who stays in Cape Town, cooks a good meal sometimes, and he also presents Small Talk Daily. And now we are going to be taking a focused look on our food sector in particular. But this is a guy who's also very, very busy. He was telling me that in the last few days, how many, 15 days?
In the last 15 days, I've seen 34 corporate updates.
Right. We're going to try and drag that stuff out of you as much as we can. Let's begin with an overall look. That crop estimate committee coming through with some numbers. I want to know if they change the picture for the food sector, and if they do, who's hurting and where should we be buying?
Yeah, the crop estimate committee is a very important government body under the Department of Agriculture, Forestries and Fisheries. They put out an update once a month, and the latest came out at 2:30 yesterday. Basically, they said the maize harvest in this country is slightly better in terms of its shape compared to February. They upgraded the total harvest by just 0.48% to 10.561 million tonnes. But more importantly, they improved the white maize harvest, which is what consumers eat, by 1.48% to just over 5.3 million tonnes. Now, these may be very small percentage changes, but it just indicates to the market that the harvest is currently in good shape. There's more than enough maize to go around for the needs of the animal producers, poultry, cows, etc., and of course the human consumption. That should mean that the SAFEX price of maize should fall, which is good for us, which is good for the consumer and good for overall food inflation.
Okay. Now, I saw some stocks running. I think it was earlier actually, but I want first of all to get the overall picture in terms of who is likely to benefit out of this.
Well, the key beneficiaries, if you're a large user of maize, like Pioneer Foods that uses 950,000 tonnes a year, or Astral Foods, the country's biggest chicken company, that uses 800,000 tonnes, if you're expecting a slightly better crop and the prices that you pay per tonne falls, in theory going forward, it'll benefit you as a producer.
And your margin.
And your margin. However, in the short term, they're coming off a very low harvest of a low base of last year. So most food companies year on year are seeing materially higher prices for their main input, probably between 700 and 800 rand a tonne, which is why most food companies have reported really bad trading updates so far this year. AVI, Pioneer Foods, Tiger Brands, RCL. We've got Rhodes coming out fairly shortly. They've all had really awful updates. It's not going to get any better anytime soon. The reason why I'm forecasting the harvest right now is it shows that going forward, things will get better. So earnings season for the next 6 to 9 months will be weak, and use the weakness, particularly in certain counters like Pioneer Foods and Astral Foods, to buy in recovery, I'm stating, in Q3 2019.
Yeah, I saw RCL running a little bit last week. What was that about?
Well, they've had a bit of a smack in the last couple of weeks. As we discussed before we came on air, load shedding has been an enormous factor to food companies in the last couple of weeks, as it has been to people in Joburg as well as Cape Town, where I stay. If you're a food manufacturing company, you can't really rely on generators or solar power to power your major manufacturing operations. And I've had feedback from Pioneer Foods and from Libstar as examples. When load shedding suddenly hits, sometimes for 2, 3, 4, 5 hours or more a day, they physically have to shut down their factory, throw away the food they've started to produce for hygiene reasons, clean the factories and then start again. You cannot recover one day's lost production. The cost of cleaning, raw materials, input costs, wages, all gets lost in one day. So I think the bigger picture with load shedding, it's an inconvenience to us, but traffic gets hit. But to manufacturing companies involved in certain parts of the food chain, like food, it is a devastating impact on a short-term basis, and that will have a profit impact in pending results to March and in the second half of the year.
In my head, I'm thinking maybe what we should do is group them all together under one roof, and then we give them a line to the grid that does not get shut down like OR Tambo Airport.
Well, I'll give you an example. Pioneer Foods told me last week that if a factory that makes bread is suddenly hit by load shedding, all the bread that has been manufactured, proved and cooked has to be thrown away. Can you imagine how many loaves of bread a day is being wasted purely because of load shedding, which then affects the poor and the food society in this country?
100%. Let's go to that opening picture that you painted for me. So 15 days, 16 days, how many companies? 32?
34, I think, so far.
34 companies that way. So I want you to give me a picture of what you have seen.
It's not pretty out there. I think in many of the industrial counters, they've all seen the effects of a very weak economy, particularly in the mining and manufacturing side, where there's very little activity. Thankfully, the weakness of the rand means that anybody that's exporting is doing a little bit better.
Yeah.
On the food and consumer-related industries, the effect, again, as we've seen from the trading updates, and the fact that consumers have got very tight purses and very tight wallets means that the underlying volume growth is quite weak, leading to margin contraction, higher costs from not just electricity but wages, the minimum wage being increased, which is a good thing for the poor, but has an immediate impact to companies involved in manufacturing.
Sure.
Will also have an effect on earnings. I really don't believe the earnings season which we'll see going forward from the March interims and finals will be anything to write home about. I think it'll get a lot worse.
That's interesting, Anthony, because Old Mutual gave an update, I think, on their overall market view for the next quarter. And one of the views that I picked up was that they think that South African shares are at the bottom. Obviously, this is like your big picture. It does not account for your single stocks. But the overall impression they give is that this market has been so beaten down hard, come on, from on here, it has to only go higher. But you're saying this is not going to be anytime soon. Would you write off the rest of the year?
No, I think what we've got right now, reporting season for the March period is not going to be good. We've got an election coming up in May. We then have to see the composition of the cabinet to see what policies will be. We then have to see what Moody's says with a downgrade. If you're an investor looking at domestic South African stocks, and I look at purely domestic stocks, why would you want to buy the stocks, even if they look beaten down and cheap, when you've got so much uncertainty literally coming at you in the next 3 months? Results, election, cabinet, Moody's. You would hang off and wait for perhaps better times to maybe show green shoots towards the end of the year. So whilst many stocks in my sector look extremely cheap, it doesn't mean they're going to get cheap. It doesn't mean they won't get any cheaper. I think they will.
Absolutely. Over to you, Cyril. Sort that out and the market will run. I want you to pick, in the last 1.5 minutes that we've got left, I want you to pick stocks that you can talk about. But I'm going to point you into Ascentis Healthcare, because that company certainly is in trouble. The worst performer last year, under pressure again this year. Is it going down?
I was at a results presentation in Cape Town, and I grilled management to the point that they actually made a comment to the market that some hard-arsed analyst had interrogated them, and that's my job. What we've seen is the share price completely collapsed to around 4 rand currently. They have a massive debt situation. They are probably forced to sell one of their star crown jewel assets, which is Remedica, based in Cyprus, to repay debt. And we've got one forced seller, which is their private equity transaction, private equity particle Coast to Coast. That director was pushed off a board yesterday.
Yes, I saw.
Because he's got nearly 100 million shares in the company with more to sell. As it stands right now, unless Ascentis Health starts to reduce its debt quite rapidly through asset sales or lending or renegotiating with its lender, I certainly would not use the weakness in the share price to bottom fish, saying it looks cheap. Let's give it a go. There is too much uncertainty. The market doesn't like debt. It doesn't like being misled. And if there's a forced seller in the marketplace and you've got the stock weakening day in, day out, why would you want to take a risk of buying a cheap stock when there's too much uncertainty regarding its financial position? I certainly wouldn't be recommending Ascentis anytime soon until there's clarity on its debt reduction and its capital asset sales.
Dire times for this company. I'm looking at the stock right now. It was around 4 rand 80 at the beginning of the day. We're sitting now at the moment at 3 rand 85. It fell as low as 3 rand 70. Pick another two.
Another two, I think a stock that looks very interesting. Another stock that was beaten down very hard in the last few months is Metrofile. Now, for anyone shuffling bits of paper, as you are there, Godfrey, Metrofile is basically a documents management company. It stores paper. Whenever you open a bank account, a cell phone contract, or a store card, reams of paper needs to be signed and stored for up to 7 years. There's also the Protection of Personal Information Act called POPI, which means that records have to be saved. Metrofile is the largest provider of those services in the country. However, it had a very large acquisition in Kenya, which costed a great deal of money. They didn't structure their debt properly, so we had a huge increase in finance payments in the last 12 months. The digital migration policy was flawed and didn't work to anything of a degree that they hoped, and earnings fell quite sharply. At the interim stage, we had 10 cents in earnings, and the share price, which was trading probably at around 4 rand over a year ago, is now trading between 130 and 150. Now, I say all this because Metrofile, in the old days, was a cast iron bankrolled company which you could give to widows and orphans, knowing it would provide consistent earnings and consistent dividend. It's now been completely beaten down.
Yeah.
It's on a PE going forward, to my numbers, of around 6.
Sure.
It's owned by the well-known investor, Christopher Seabrook. Now, Mr. Seabrook, if he sorts this company out, he also owns Sabvest and Rolfs.
Yes, I
he
remember
told me
them.
last Thursday he's going to be going in and sorting the company out on a 6-month
White
view.
in shining armor.
So perhaps at £1.30 to £1.50,
Yeah.
on a beaten down scenario,
Yeah.
with a white knight coming in to rescue the company,
Yeah.
Metrofile on a P of 6, given its cash generative annuity-based system,
Yeah.
is one that I would certainly recommend looking at for the next 6
Those
to 12
records
months.
are continue going there. All right. Last 2 questions. I want you to talk about the education sector, Advertech, Curo, and Stadio. And then, before you leave, you've got to talk to me about CAP and Steinhoff exiting and why that's bad for CAP, because I saw CAP down the other day. I don't know whether it's up today. I'm going to check.
On the education sector, it's a sector that I followed closely for nearly quarter century. I'm a lot older than I look. We've had results out from Advertech, Curo, and Stadio in the last 3 weeks. I've seen management of all 3 companies.
Yeah.
In Advertech's case, it was a very interesting dynamic because the tertiary education side it did extremely well and produced a robust set of profits north of 20%. The school side, which has grown dramatically in the last few years from acquisitions, once again, for the 5th consecutive year, has had poor growth in profits, and the margin continues to fall. Because what they've done is to chase off Curo, which made an unsolicited bid many years ago. They went out on a massive acquisition spree. But acquisition spree has not really worked.
Yeah.
It's increased learner numbers, but it hasn't really led to substantial profit uplift. Further, most of Advertech schools are in the high-end Crawford College sort of model. In tough economic times,
Yeah.
when people are emigrating from the country, entrepreneurs and business people who are taking their kids overseas, you are trading down from more expensive schools to more affordable schools. So they have seen a natural attrition in their profits because of tough economic times and people going to more affordable schools like Curo.
Sure.
So in their last Curo results, their results were up over 20% because they have affordable schools, paying much less in monthly fees, targeting a much bigger demographics, with 68% of their learners coming from black children.
Right.
On Stadio, it's an education stock in the tertiary side, fast growing, and Dr. Chris van der Merwe is taking that company to strong places. It earned about 8 cents in the last numbers, and I think it'll grow a lot faster than the market believes. And given that Advertech's tertiary side is doing fantastically well, Stadio is also well positioned in due course to do well.
It sounds to me like you're saying Stadio and Curo are your stocks
my 2
to go
preferred
to.
stocks.
Yeah, watch Advertech. Okay, so I did look at that CAP Industrial share is down 7% after the exit of Steinhoff, and I was thinking, but that must be a good thing.
Listen, we all know what's going on with Steinhoff. Steinhoff needed to raise money to repay its debts.
It's a fire sale, essentially.
It is a fire sale. It's more than a fire sale. It's a fire sale doused in petrol. CAP is a brilliant business. It's a stock that I've been covering for a while.
Yeah.
They had results out probably when I was here the last time we spoke. Really clear, concise results. A really well-organized company. In my mind, if there's a large incumbent shareholder who was there and you know he was going to be selling, let them get out.
Right.
Let them exit. Let the market absorb the stock.
Yeah.
And then they can carry on their business in a solid, unencumbered fashion, knowing there's no fire sale in the future.
Yeah.
I'd say Steinhoff exiting CAP is one of the best moves that I have heard in that stock in quite some time. And I think after the market looks through the sale, and once the stock has been digested, they will look at solid fundamentals and say, you know what, great business, let's keep on supporting this company.
Which surprises me because I thought the book build was oversubscribed. Yet that stock is down 7%.
Well, it's probably a function of the fact that the market's been absorbing a large
overhang.
amount of stock, which means there's no natural buyers because of all their books and now all their purses have been filled with CAP stock following the placement.
Anthony Clark, as always.
Pleasure.
Thank you, sir. Thank you, sir. Anthony Clark, independent analyst, based in Cape Town and at Small Talk Daily.